It's a very deep liquid market. It's the world's deepest, most liquid capital market, right? That's what makes it special. On the weekend, you want to put $1 billion trade on with 20x leverage, you can do it in Bitcoin. You want $1 billion of credit in an hour, you could do it in Bitcoin. It's a very deep market. And I do think macro factors drive it, and sometimes it's got a life of its own. I think micro factors drive it. I mean, the industry factors are like the formation of digital credit, the formation of bank credit, and investor sentiment with regard to digital assets, and those drive it as well.
If you found this helpful, please like, subscribe, and turn on notifications for more insights into the digital asset space. Your support boosts the algorithm and helps this channel grow immensely. Drop your thoughts in the comments below. Thanks for watching and enjoy the rest of the video. One of the key points Saylor emphasizes is that despite MicroStrategy purchasing tens of billions of dollars worth of Bitcoin, the company still does not control the Bitcoin market. He explains that people often assume large Bitcoin purchases should automatically drive prices higher. But according to him, the Bitcoin market is now so large and liquid that even billion-dollar purchases barely create noticeable movement. Saylor says MicroStrategy has bought Bitcoin at rates of $100 million per hour, $200 million per hour, and even $300 million within a single hour without significantly affecting the market price. That statement alone highlights just how massive Bitcoin's liquidity has become. He compares Bitcoin to a global macro asset, something influenced far more by geopolitical tensions, monetary policy, foreign policy, and global economic conditions than by any single buyer or seller. In Saylor's view, Bitcoin behaves more like a global capital network than a traditional stock or commodity. Factors like trade wars, interest rate policy, currency devaluations, central bank decisions, geopolitical conflicts, global liquidity conditions all play a bigger role in Bitcoin's movement than MicroStrategy itself. And this is actually one of the reasons Saylor believes Bitcoin is so powerful, because no single entity controls it, no corporation, no government, no billionaire, no central bank. Bitcoin operates as a decentralized global financial system, driven by collective market forces. Cat stretches dramatically across stolen blanket. Unlike me, I control everything in this house.
What happens as we approach the dividend date is there's a massive demand to buy STRC because there's like a 90-cent dividend after that record date. So there are billions and billions of dollars of trading in STRC leading up to it. And then the day after that record date, it trades down 60 cents or 70 cents, and then it gradually recovers back to par over the next week or two. So that's normal. Those are arbitrageurs. Their ideas. I want to commit $1 million of capital for one day, and I'm capturing 42% annual yield a year by having my capital tied up 12 days a year or something. And they've got their math. That's fine. It's good for us because it creates liquidity and engagement, and that will continue. As for the second idea, can you front run that in the Bitcoin market? Well, the Bitcoin derivatives market's $50 billion a day. And so do I think someone has enough capital to move that market? Not really. My opinion there is Bitcoin is kind of like tech capital squared. And so the things that drive the Bitcoin market are trade wars, hot wars, foreign policy, the state in the Strait of Hormuz and the Iran situation, and then currency wars. You know, whether or not we're expecting SOFR to fall to 200 basis points, or whether the yield curve is being bent. And you can see right now we're in a fairly restrictive monetary environment. So those macro factors are the primary driver of Bitcoin. I can tell you for a fact, for example, we bought $100 million of Bitcoin an hour. It doesn't move the price. We bought $200 million of Bitcoin an hour. It doesn't move the price. We have bought $200 million of Bitcoin an hour, or $300 million in an hour, and stopped. The price goes up. Okay, so for anyone that thinks that they have enough power, well, you know, maybe if you're going to bring $30 billion to the market in one afternoon, maybe, but I have spent lots of money. We bought more Bitcoin than anybody that I know of. I think we probably acquired $62 billion of Bitcoin. What I believe is that it's a global market. It's got dynamics all its own. It's driven by foreign policy. And if the Chinese government has a certain announcement, that drives the price of Bitcoin. And so it's flattering to suggest that we're that systemically important. I don't think so.
Why is it that you buy so much Bitcoin and you said the price doesn't move?
The market is very liquid. It's extremely liquid. Again, so let's say I had a big day and I bought $1 billion. Well, $1 billion is 1/50th of 50 billion. If you talk to the traders, they'll say that the spot market's 20 billion, but the derivatives is 80 billion sometimes. So what's $100 million in a 40, 50, 60 billion dollar bucket? It's a very deep liquid market. It's the world's deepest, most liquid capital market, right? That's what makes it special. On the weekend, you want to put $1 billion trade on with 20x leverage, you can do it in Bitcoin. You want $1 billion of credit in an hour, you can do it in Bitcoin. It's a very deep market. And I do think macro factors drive it, and sometimes it's got a life of its own. I think micro factors drive it. I mean, the industry factors are like the formation of digital credit, the formation of bank credit, and investor sentiment with regard to digital assets, and those drive it as well. But I think that it's greater than all of us, and that's actually why we have confidence in it, because there is no one actor that's either supporting it or holding it back. I think when you have tight monetary policy, high tensions in global trading, and high geopolitical tensions due to foreign policy or wars, whether in the Ukraine or Iran, all those are somewhat constrictive and they're headwinds. And I think when they reverse, they become tailwinds. But Bitcoin will grind up regardless, and that's because there's about $10 to $12 billion a year in organic supply from the miners, 450 Bitcoin a day, so figure it out. And then every time we come up with another $10 billion of capital, we buy the entire year's supply. And so if a bank creates $10 billion of credit, that's one turn on the axle. If we sell $10 billion of STRC, of digital credit, that's a second turn on the axle. When $10 billion flows into IBIT, that's a third turn on the axle. So the capital flows in digital credit, in digital capital wrappers and bank credit, all of those things are driving the fundamentals of the market. And those are all positive, and you're going to see continued adoption there regardless of the macro factors. Just the macro wins. When we're grinding up 30%, we surge to 50%. And when there's a headwind, it'll somewhat slow us down.
Has your thesis on Bitcoin changed a bit?
It hasn't changed, but I will say this. It's clear that Bitcoin is digital capital. And one thing that's become clear over the last 12 months is that at least one of the killer apps of Bitcoin is digital credit. So people are wondering, what is the killer app of a $1.5 trillion asset class that trades tens of billions a day? And the answer is as collateral for credit. So if the digital capital is the highest performing capital asset, and it is, right? It's outperforming the S&P by a factor of 2 to 3. Then it stands to reason that we can create the highest performing credit asset on top of that capital asset. And what we've seen in the last year is Stretch is the most liquid credit instrument. It's the most liquid preferred stock in the entire market. It's the biggest preferred stock in the market. It has the highest Sharpe ratio. So we've managed to create an instrument with a vol of 3 with performance of 11.5% dividend yield, a Sharpe ratio of 2.5 to 3. The highest credit instrument Sharpe ratio is 0.5. The highest Sharpe ratio on an equity is Nvidia. It's like 1.7. The highest Sharpe ratio you would get with any other asset is like 0.9 on the S&P or 0.85 on Bitcoin. None of them beat 1. And then the best hedge funds you find can't do a Sharpe ratio of more than 2.2. So digital credit is actually got a better risk-adjusted return than every other financial strategy and every publicly trading instrument in the public capital markets. 12 months ago, I couldn't tell you that, but it makes sense that If Bitcoin is the highest performing capital, then convertible bonds backed by Bitcoin become the best performing convertible bonds, and credit instruments like STRC become the best performing preferred stocks. By the way, do you know what percentage of the preferred stock market we are this year?
I would assume over 70.
We issued 60%
60.
of all the preferred stock in
That's
the United
insane.
States
Wow.
this year. And we are the largest issuer of credit in the entire United States last year and this year. We have revitalized the preferred stock market, right? It's exploded. So I think what's new is the idea that digital capital drives digital credit. And what you'll see as this show is that digital credit is the stepping stone for digital currency or digital money, because there's an explosion of yield coins, tokens that are stable, pegged to the dollar, that pay you 8% or 9% yield. Apex has created one. It's gone from 0 to $300 million in like 8 weeks. Saturn has created another one. It's gone from 0 to $110 million in 6 weeks. There's an explosion of innovation in the digital asset space and the crypto space and the TradFi space that's all being driven by digital credit, and Bitcoin is the thing that makes digital credit possible, and that is probably the most exciting thing happening this year.
Saylor repeatedly describes Bitcoin as the deepest and most liquid capital market in the world. That's a massive claim, but his reasoning is fascinating. According to him, Bitcoin trades tens of billions of dollars daily across both spot and derivatives markets. The derivatives market alone can exceed $50 billion to $80 billion in daily volume. This level of liquidity means institutional investors can execute extremely large trades quickly without causing major disruptions. Saylor argues this makes Bitcoin unique compared to traditional assets like stocks, bonds, or real estate. He explains that on weekends, when traditional financial markets are closed, traders can still access enormous leverage and liquidity through Bitcoin markets. That uninterrupted global trading creates a completely different type of financial infrastructure, and this is where Saylor's broader thesis becomes important. He no longer views Bitcoin simply as digital gold. He views Bitcoin as digital capital, a foundational asset layer upon which entirely new financial products can be based.
The number one Bitcoin accretion engine is STRC. We sold $3.2 billion of STRC in April. So we bought $3.2 billion of Bitcoin. The dividend is about 80 to 90 million. So in the month when we're raising $3 billion, we need to come up with 80 or 90 million dollars to pay the dividend. So you would be, in essence, you would be buying 30 Bitcoin, selling 1 Bitcoin, right? Our break-even rate is 2.3%. So what that means is that if we sell STRC, if we issue STRC credit equal to 2.3% of our Bitcoin holdings, then that means we will be a net buyer of Bitcoin forever, even if we sell Bitcoin to pay the dividend. Another point is that if Bitcoin appreciates 2.3% a year, we can pay the dividends forever, right? And continue to grow value, right? And we can do it without selling any common equity. So the break even is 2.3. Right now we've sold about $5 billion of STRC in the first 4 months of the year. So we're running on a pace to have an issuance rate of 15 or 20% this year. 2.3% is the break even. So you buy 20, you sell 2, you net 18, right? The company, as long as it grows, is going to buy more Bitcoin than it sells. I expect we'll be a net buyer of Bitcoin in every month and every quarter, going on forever.
A lot of investors believe this never sell your Bitcoin religiously, right? And do you think they should still follow that suggestion?
Yeah, I think that you should be a net accumulator of Bitcoin. Like when I say never sell your Bitcoin, I mean, make sure that if you were to spend it on something, you replenish it in the time you spend it. So there are also a lot of crypto people or a lot of Bitcoin people that say they want to spend Bitcoin to buy things. And if you were to spend Bitcoin, I would say just replenish the Bitcoin. So you don't want to be a net seller of Bitcoin, because Bitcoin is capital. You want to end every year with more Bitcoin than you started the year. And the analogy I'd give you is if Google spent $1 billion to invest in data centers so that they could make $10 billion, they're making net $9 billion. It wouldn't crash the dollar market, right? Oh, Google spent dollars. Google sold dollars to buy data centers. The dollar would be fine. It wouldn't undermine the Google business model. Oh, they spent $1 billion to invest in their business. That's fine, right? And so it'd be fine for Google. It's a rational thing to do. Sometimes you spend money to make more money. So if you're spending 1 Bitcoin to make 10 Bitcoin, I think it's fine for Bitcoin. I think it's fine for the company. I think it strengthens our company because if our company has the ability to tap the crypto liquidity market, if we can raise liquidity by selling spot Bitcoin, that's a $20 billion spot market and a $50 billion derivative market every day. That's a powerful energy source. So we want to be able to tap that market when the equity capital markets aren't as liquid as the commodity market for Bitcoin. And so whenever a company strips its options, whenever we say we will never do something, we always regret it, whatever it is. Give you another example, right? If we say we would never ever buy our stock, we would always sell our stock, then short sellers would sell our stock and they would sell it down to $1. The stock trades at a big discount to NAV, we would buy it back. Then the short sellers have something to lose, then we would make a lot of money by them being irrational. And so what we did say in our earnings call yesterday is we're prepared to trade stretch for the common stock. We'll trade STRC for MSTR. We'll trade BTC for MSTR. We will fund our obligations with BTC or MSTR. We'll do whatever's in the best interest of the company. But, you know, over time, we expect to be a net Bitcoin accumulator. That doesn't change. The way that we trade our assets day to day, whether we sell credit or sell equity or sell capital assets, that will be a function of the market and mispricings. And if, you know, the other thing we said yesterday is we're ready to buy our bonds back. So our corporate bonds trade cheap. They're undervalued, and so it makes sense for us to buy them. It doesn't make sense to sell them. So we don't sell assets that are undervalued. We buy assets that are undervalued, and then we arbitrage whatever the inefficiency is. And if the market knows we're going to do that, then the market's going to actually fairly value all those assets. And that's to the benefit of all the investors and all those instruments. And ultimately, that's our fiduciary obligation.
Despite acknowledging macroeconomic headwinds like high interest rates, geopolitical tensions, and restrictive monetary policy, Saylor remains overwhelmingly bullish on Bitcoin. His reasoning comes down to supply and demand. Bitcoin's supply issuance remains extremely limited. Only around 450 Bitcoin are mined daily. That represents roughly $10 to $12 billion in annual new supply entering the market. Saylor argues that whenever institutions raise another $10 billion to buy Bitcoin, they effectively absorb an entire year's worth of newly mined supply. And today, multiple sources of institutional demand are emerging simultaneously: ETF inflows, corporate treasury purchases, Bitcoin-backed credit products, digital yield instruments, institutional adoption, bank credit expansion. According to Saylor, all of these forces create persistent upward pressure on Bitcoin over time. Macro conditions may accelerate or slow the process temporarily, but the long-term direction, in his view, remains inevitable. Cat suddenly freezes and stares into empty hallway for 14 seconds. The orange cat from next door knows something. I can feel it.